Doing a little bit of a year-end recap, kind of predictions for 2015, as well as some changes coming to mortgage and title in 2015. I have Arnie Diaz with Waterstone Mortgage with me, as well as Aaron Davis from Hillsborough Title for our last show of the year. It's been a great year, but this is the last show of the year, and we like to, we always like to do a little recap, talk about, what we saw in 2014, what we're going to see in 2015. I think the first part of it, I'll let you guys kind of talk on what you see as kind of your recap. The market prices across Tampa Bay rose about 10%. We're seeing more home sales, less inventory. We're seeing a healthier real estate market, a much more balanced real estate market. Interest rates still historically low. We're starting to see the trend away from all the institutional investors back to the retail buyers. And we're seeing gains in pretty much all price ranges. You're seeing high-end homes, low-end homes, you name it, we're noticing it. So from my business's perspective, we grew on the retail side of our business. We grew about 50% this year. We did a lot of hedge fund and corporate work last year when that was hot in the market, and our business grew past that and replaced that business with regular resale buyers. Aaron, how about you? What some things you saw on the title side, as a recap for 2014, not just your business, but then in the market, and then I'll get to Arnie too, and then after that we'll talk about some predictions for next year.
Yeah, I think that the number one word to describe it is confidence. I think you saw a lot of confidence in the market. A lot of, like you said, a lot of the hedge funds did seem to kind of peel out a little bit, though they're still there.
They're still buying, but just not
as
much.
Crazy.
I mean, we've sold. Yeah, we sell a couple homes a month to different institutional investors, but not like it was.
Yeah, and in the title world right now, there's a lot of there's a lot of consolidation going on. It is a narrowing field. There's a lot of changes, which we'll talk about in a little bit.
And that's probably what's prompting the change. And when you say a narrowing field, you mean a lot of title companies merging, which obviously you guys have been doing a lot of, or getting out?
A little bit of both. Lots of mergers and acquisitions, and lots of folks kind of getting out of the business because the cost of doing business is going up so much. And it's really the lenders who are going to kind of be driving traffic here pretty soon, as far as the decisions being made as to where you can close. So, in our world, our business in December of last year, we had 8 offices and 70 employees. Today we have 27 offices and 200 employees.
Right.
So, and there are others growing like us. There's other ones that are also shrinking back quite a bit. So,
right.
So lots of activity in our world, but really getting prepared for this year, 2015. It's going to be a big one.
Right. And Arnie, on the lending side of things, so a recap of some things we saw this year, as well as things you guys saw, on the lending side of things.
Well, I think that the last few years, there's been quite a bit of refinance activity, but as we go out in the market this year, that is dwindling down, and it's predicted to dwindle down even more next year as rates continue to inch up.
Right. Makes less and less sense. Yeah,
makes less and less sense. But also what we saw is most people have already refinanced, and so we actually got a lot of requests from people that were already in the low 4s thinking they can get better, or we may get a little bit better, but it doesn't make sense.
Right, it doesn't make sense to do it for the cost, right?
For the cost. And so, it's like, okay, this is like the best year we're probably going to see in our lifetime, I would think, and it's going to go up from here. So if you haven't refinanced by now, you better jump on the bandwagon, or you're going to miss out totally. Or you've already done it and you need to kind of wait, and hopefully your home will appreciate in value, like we've seen the stats are doing, and that way you'll be in a position maybe to do a cash out refinance and pull some of that equity out. Otherwise, refinances are dying. They're going to be a dinosaur here for the short term.
Right.
But outside of that, I think that the big thing is that the small player in the mortgage lending division pillar or sector has gained a lot of market share from the big banks.
Right, because of how bad the big banks have been.
It's just too many overlays.
Right.
People say, what's an overlay? Well, you go directly to Fannie Mae, or you go directly to Ginnie Mae, which is the FHA investor.
Yeah.
It's HUD, and they have their guidelines, and you're supposed to follow their guidelines.
Well, the banks, they do the overlays, and the overlay is basically what the bank bank says they're going to change the terms of what the investor will buy the loan for.
They're going to make it more restrictive to protect themselves even more. And you know, right? Maybe they've gotten burned a little bit. And they want to do some of that, but they just swung the pendulum. The big banks have swung the pendulum way too far as conservative, being conservative, and so that's opened the market a lot for the smaller players, the Waterstone mortgages like ourselves. That maybe not as big a name. We're still traded on NASDAQ, but at the end of the day, it's not a household name. But you know, we are more flexible and follow the guidelines a little bit closer, so therefore it creates more opportunity for us.
And I think, you know, the other side of that equation is what we talked about. Mortgage loan origination is up considerably because while we're still seeing a lot of cash, we're seeing less of it. You know, we're seeing less cash than we saw a year and 2 years ago. Still an astronomical amount of cash, don't get me wrong, but we're seeing less of it, so there's more mortgages being generated because some of those, you know, individuals are deciding either to get mortgages or they're institutional and they're deciding not to buy more, and that lets Joe Blow down the street, the average Joe, buy a home that he couldn't a year or two ago with the hedge funds.
And I think you're seeing too. You're starting to see some of these articles come out in the paper where it's smarter again to own than buy. You know, or I'm sorry, to buy than rent. And you know, so you're starting to see some of those ratios getting back to where it's attractive. I think you've got millennials, you've got some folks coming back into the market now. There's more confidence, and it's time to own a home.
Yeah, let's talk about the predictions for 2015. I think that's a good segue for it because, you know, I saw an article from the CEO of Zillow this week, and you know, growth in rents will outpace home values was one of his topics, which means rents are rising faster, meaning that if you're renting, it's time to buy. The second part of that is millennials will overtake Gen X as the largest home buying age group. So you've got more first-time home buyers looking at the financial side of it, making a business decision, saying it makes more sense for me to buy than to rent for what I'm paying and what I get in the grand scheme of things. And I think both of our industries are going to make, you know, that a big focus. Then you've got the builder segment. Builders you're seeing them building less expensive, smaller homes to cater to it. You're going to see a lot of first-time entry, you know, production from Lennar, from D.R. Horton, from Ryland, all the big builders. I think you're going to see a huge trend where they're going after that, you know, hard to find right now $200,000 new single-family home market. You're going to see a lot more production of that to attract it. And I think that all those things we've just talked about are why 2015 is going to be a big first-time home buyer market. You know, it's just setting up for it perfectly, where, you know, that is going to be our target. And you know, other things that I see in the market, I see prices continuing to rise. Now, I'm not talking like lottery rises. I'm not talking like big explosions, but prices are going to gradually increase. Our real estate market in Tampa Bay, I can't say the same for everywhere across the country because real estate's local, but it's healthy.
You know, just this past week, the gross domestic product numbers came out. It was 5%. It was a huge number that came out. And of all the things that help the economy and help appreciation and help all that is when the economy gets better, more people are going to want to jump in the market.
And they're not as nervous. Right? They're not as nervous.
Right.
They're willing to take that risk and come out of the pocket.
I think we had seen a few economists here recently, you know, talking about 2015 and 2016 both being banner years. And one thing that was interesting too, and I've noticed this a lot recently, gas prices. Gas prices have a direct effect on home ownership and home purchasing in Florida, especially because, you know, people are driving around. They're more apt to travel and go see Orlando and Tampa Bay. And so you'll see a lot of folks starting, you know, buying even more homes in these areas because of that.
Here's the thing: what people don't realize about the impact of gas. It's something that you spend. You're spending it constantly. It's something you buy constantly. It's an ongoing, repetitive thing, and it's one of those constant costs that can fluctuate. You know, you don't go to Subway and have the price of your sub or a Chipotle down the street. It's not going to be different in a week. It's going to be, you know, whatever it's going to be that. They might raise it occasionally, but you don't see this fluctuation. So when you see that drop in gas prices, the average consumer, actually, I think any consumer looks at that as, oh, things are good. I'm happy. I'm not spending as much here at the pump, and it has a huge psychological impact on you being able to be comfortable spending some money, because now you've got an extra 20, 30, 50 bucks here and there, you know, and then all of a sudden your affordability changes because of your constant spending. So it's a psychological thing just as much as it is a financial thing.
Well, psychological is absolutely correct, Andrew, because 2008 in the financial markets, everybody took a hit. And I think our psychology, our buying psychology, affects our history, and what we saw people go through affects our future psychology of buying.
Sure.
Okay. And so hence we saw a lot of pain in 08, 09. Okay. That's where all the cash came out, because the markets, you know, the stock market was going down. You couldn't get a good return. So why have the cash in the stock market? All of a sudden, cash started coming in. I mean, I've been doing this 31 years. I've never seen so much cash in my life.
Right.
Okay.
Right.
And for such an extended time. So I think then, well, all of a sudden, then the stock market got better with some of their returns, but yet they had such pain in 08, it was hard for them to convert. Now you're starting to see, okay, now they're starting to feel better about the economy, gas going down. Now it's time to maybe look and see other sources of getting a return on that cash. And so maybe that's why some of that cash is doing it. The other thing is the millennials saw their parents go through pain, go through a lot of foreclosure, stuff like that. They were scared to jump into the market.
They were, no question. I think
Yeah.
there was a fear about it, and I think also when you're the millennial, you're young professional, you're starting out. Some of those costs that you have that really aren't, you can't change. In other words, if you're driving, you're going to pay gas, right?
Right.
You're going to have gas, you're going to have insurance, you're going to have those things. And a lot of those costs don't fluctuate much. So when one of them does drop 30, 40%, it makes a big impact on you, when you don't have a lot of extra money, to where then they can say, well, I might be able to save $1,000 or $2,000 or $3,000. And that's really all it takes to buy a first home today. People have a misunderstanding of how much money they need down to buy a home.
And as the economy improves, your employer is going to be willing, if you're a valued employee, going to pay you more money.
Right.
And
The market's going to, and so you got all those factors coming, which is why, again, I think 2015 is going to be a banner year for first-time home buyers. I think you're going to see a huge drive by builders to build product to cater to it. I think you're going to see more techie type homes with, plug-in, HDMI, or plug-in, you can charge your iPhone in the wall instead of needing the out. I mean, you're just going to see all these new technology trends to cater to that audience, and you're seeing the products for it too. We're going to continue the conversation. We're going to talk after the break about some changes coming to mortgages and title and how closings are structured. This is really important for you to pay attention to if you're going to be buying or selling a home the next year or know someone that is, because it is going to markedly change how real estate closings happen. We're going to talk about that after a quick break here on the Duncan Duo Show.